Okay, good evening. We're going to get started. I'm Rajiv Dehejia, Professor of Public Policy at NYU's Wagner School of Public Service and co-director of the Development Research Institute alongside Bill Easterly and our colleague Yao Nyarko, who unfortunately could not be here tonight. The Development Research Institute is dedicated to rigorous thought on challenges of global poverty reduction, seeking to expand the diversity of commentators. Since our founding in 2006, when Bill and Yao started it, we've been committed to dialogue not only or even mainly within the academic world, but also engaging in public dialogues such as the one we're having this evening. And also crucially involving those in the developing world who are both the subject and object of development debates. It is a great pleasure to welcome you to this evening's dialogue on infrastructure. The event serves as the launch for Sadek Wahba's new book, Build Investing in America's Infrastructure, and also an opportunity to hear and participate in a conversation between Sadek and Ed Glaeser, the renowned urban economist and a member of the Department of Economics at Harvard. The conversation will be moderated by Liz Huffman, who is the business and finance editor at Semafor. I'm going to break the cardinal rule of introductions, which is normally the more interesting the speakers, the longer the introduction. I'm going to keep it brief because we all know why we want to hear from these speakers. Sadek Wahba is chairman and managing partner of I2 Capital, an independent multi-billion-dollar global infrastructure investment company. He worked previously at the World Bank and Morgan Stanley. Sadek holds a PhD in economics from Harvard, where we were actually in graduate school together a long time ago, looking a little bit younger. We, in fact, wrote our first academic papers together. Sadek has, in all of these roles, he has talked the talk, he has walked the different walks in the world of infrastructure, and so we're very pleased to be able to host him here tonight. There's a number of other honors and distinctions, which I will leave to your imagination. There are many. Edward Glaeser is the Fred and Eleanor Glim Professor of Economics, and to his great relief, no longer the chairman of the Department of Economics at Harvard, but until recently, he was indeed also the chairman of the economics department. He's taught microeconomic theory, occasionally urban and public economics there since 1992. I was lucky enough to have Ed as one of my thesis advisors, and so it's kind of a little reunion from our days at Harvard among the three of us. Ed has been at the forefront of the revival of urban economics within the economics profession. And he's published dozens of papers on cities, economic growth, law and economics. And he is also the author of a number of books that have reached a broader intellectual audience, including Triumph of the City, The Rise and Decline of Nations, and with David Cutler, Survival of the City, Living and Thriving in an Age of Isolation. Liz Huffman is senior business and finance editor at Semafor. She joined from the Wall Street Journal, where she spent 9 years covering M&A, investment banking, and the world of big money. She's the author of Crash Landing, the inside story of how the world's biggest companies survived an economy on the brink, a book about the economic toll of the pandemic. And so with that, I will turn it over to Liz, who will be our moderator tonight.
Thank you, Rajiv. Thanks, everyone, for coming. Sadek, we'll start with you. It's your book party. I was not going to plug my book, but I did write a book. There are more profitable and pleasant ways to spend your time. So what were you trying to do? What question were you trying to answer when you set out to do this?
Well, first of all, thank you, Rajiv, for the very kind introduction and for the DRI inviting us here. And it's a pleasure to be here with an esteemed company and friends. I would say the following. Number one, when you think about the investments we've made in the US in infrastructure, we've, since the 1970s, spent less than 2% of GDP on infrastructure. China, for example, has spent over 8% since the 1980s. Obviously, starting from a different baseline, but 8% over 40 years compound, that's one hell of a number. The second thing is the way we've invested in infrastructure has been essentially mostly coming from the government. And by government, I mean states, municipalities, and so on. And then the question is, has that investment been productive in the development of our infrastructure across the board? And when you look at the statistics and the performance of infrastructure through different metrics, and I know that Ed will talk about that, and you compare that performance relative to other economies, there's something which is not right. You just intuitively, you look at our airports, you look at our roads, that tells you that we're probably not spending in the right way or investing in the right way compared to other economies. We were talking earlier about the state of infrastructure in Japan. You know, anyone who's been to Japan, I go usually once a year, that infrastructure is extraordinary. In fact, it costs less to invest in infrastructure in Japan than in the US. Yet we have a worse, in general, not every state, of course, but we have a worse infrastructure. So the idea for me was to write a book that explains a little bit the history, how that developed. Interestingly, when you look at infrastructure investments up until the Great Depression and the New Deal, most of that was done by the private sector. And then you had the Public Works Authority that effectively spent a huge amount of money in infrastructure, and then followed by World War II, which required, of course, the government to spend again on infrastructure. And what used to be owned by the private sector ended up being, over time, owned by the government. And then in the 60s, people thought that the government was doing a good job. And then by the 70s, things started to change. So I tried to understand and explain why has that happened, and then have a chapter on the different type of sectors, whether it's airports, whether it's roads, whether our water system, and then try and recommend a couple of ideas and solutions as to how we go about doing it. So the hope is that one day someone will read it and will be in a decision-making position and will say, great ideas, let me try and implement that. So that's the hope.
So Ed, I mean, so just to like kind of lay out the stakes here, infrastructure is incredibly popular. So popular that when people do it, they put up a big sign claiming credit for having done it. The idea that we don't have the money is silly. Both parties are pretty comfortable with deficits. And Sadek, you've got $40 billion of assets under management. Why is this so hard? Either the public sector screws up, the private sector screws up, or they screw up together. And maybe you could sort of take those one at a time.
So I think about there as being sort of three ways in which we screw up regularly with infrastructure. We pay far too much for it, we build the wrong stuff, and then we maintain it poorly, right? All three of these things go on. Now, paying too much for it. So NYU's transit cost database, which is a phenomenal public good, categorizing the costs on a huge number of transit projects throughout the world. In their data, U.S. projects cost approximately 3 times more per mile than other rich countries. Right? This is true within category, this is true across categories, right? We are just a tremendous cost outlier. And in fact, if you want to choose the place that is the epicenter of being a cost outlier, we don't have to leave the island of Manhattan, right? Where in fact, New York on its own particularly excels at being more costly than any place else in the world. So that's one thing, and we do know that it wasn't always like that. So the work of Leah Brooks and Zach Liskow looks at highway costs over time, where you can sort of compare apples to apples. And between the 1950s and the 1980s, costs went up spectacularly in the US, possibly because the process of building became different. Possibly because instead of just building a straight thing with very little community opposition, you had just a huge amount of litigation, veto points on everything, and the process of actually accommodating everyone who could possibly be inconvenienced by the road added to prices. Second point, building the wrong project. We have never had any serious cost-benefit analysis applied to our choosing which projects we select. Right? That's been true forever. Now, in the old days, as Adam Smith argued, right, when user fees were supposed to pay for infrastructure, then that was a pretty good way to make sure that you didn't build silly white elephant projects. Because if you had to expect user fees to pay for it, then there had to be users there. You couldn't just build a bridge in the middle of nowhere. But if it's all being paid for with a check from Washington, that discipline vanishes, and you can put things anywhere you want. And this is a second issue with the U.S., and it's something that we need to really think about hard on this. The third issue is the maintenance issue. And I have been involved in a long, multi-year process of writing a paper based on Uber's data on road roughness. So we have measured highway roughness for about 45 years. And we measure highway roughness by the Department of Transportation sends out trucks at the middle of the night, and they go at a fixed speed, and they measure how much the trucks go up and down. But that's only for federal roads. And federal roads, actually, believe it or not, right, have actually gotten substantially smoother over the last 40 years. So something actually went in the right direction on federal roads. But nobody knows local roads, and like many commuters, my time on the highway is fine. It's just as soon as I leave the highway, like my car is constantly going up and down. So it's the local roads where we have the problem. And we've never had local roads measurements really uniformly until now. Luckily, I have a month's worth of Uber data. I have the vertical, all of your phones have vertical accelerometers that measure how much it goes up and down. And I can look everywhere, okay? And so I can tell you patterns of roads. Coastal cities are much worse than non-coastal cities. The ice isn't as predictive as you'd think. Right, it turns out that New Orleans and Houston are really the worst. I can use how much people slow down at breaks to cities when roads get worse to measure how much people dislike bumpiness by seeing how much they're willing to pay for time. Our estimates are that a road in that a typical family in an overwhelmingly African-American neighborhood suffers about $300 worth of damage from bumpiness in terms of lost welfare relative to a family living in a 100% white neighborhood. That's typically about being across cities, not within cities. And in fact, in the island of Manhattan, the bumpiest roads are in Tribeca, okay? Partially because of the last thing that we're able to do is look at how likely cities are to repave their roads. And in most cities, in the 10 out of the 12 cities where we have data, there's literally zero correlation between the probability of repaving the road and the initial roughness. So there's zero correlation. They're just repaving the smoothest roads just as frequently as they're repaving the least smooth roads, right? That is a shocking fact. New York actually has a slight correlation. It's not really strong. And Denver, is through the roof, right? Denver is unbelievably good at this relative to other areas. And for me, then, the lowest hanging fruit of how to make America's infrastructure work is just repave the rougher roads first.
So when I hear that, I thought it would be interesting to do a comparison, we were talking about that earlier, with, say, roads in India. If you look at the roads in India, there's a study that you know well that shows, in fact, that privatized roads or roads that are managed by private entities have performed across different metrics much better than roads, for example, that are government-owned. That's true in Spain also, where you look at the number of accidents on privately managed roads, significantly, statistically different than, and lower, of course, than if the roads were government-owned or government-managed. What many people have done in India, when it comes to the paving and the maintenance, right, of the roads, is they've used effectively technology and AI to be able to manage these roads, and in fact have been able to reduce the maintenance capex by at least 30%. So the question, which is for me, I can't completely answer, is the technology exists, the incentives exist, the monitoring system exists in an economy like India, but for some reason we haven't been able to adopt it here over the years. You talk about user fees. The implied user fee for roads, national highways, which is effectively the gasoline tax, hasn't gone up since the 1990s, so that in real terms it's probably gone down by about 70%. So it becomes very difficult, to your earlier point, unless you have a clear market signal, pricing signal that tells you that is the effectively cost of that particular asset. No one is going to effectively spend the right time, the right amount of money, the right amount of maintenance, or identify the project that makes the most economic sense.
Absolutely. And I think I just want to highlight how outrageous it is that we have let the gas tax go down by as much as we have. What happens when that happens is that we subsidize our highways using general tax revenues. And how you can have at least the Democratic administrations that allegedly think that fighting global warming is an incredibly important thing, at the same time signing up for massive subsidization of people driving longer and longer distances on roads by using ordinary tax dollars to pay for highways rather than using gas taxes.
The other piece of using tax dollars rather than user fees is that it is more progressive, right? If you're using the tax system, which is itself progressive, maybe more or less progressive than people would like, user fees are a pretty blunt instrument and people have to drive to get to work, so it's going to disproportionately hit people, understanding that that's a policy trade-off. What do you think are the balances there, given that the politics of who's making that decision changes every 4 or 8 years?
you know, it is true, absolutely, that you know, driving actually does scale up with income. I mean, it is somewhat progressive to have gas taxes, but sure, it's not as progressive as the income tax by a wide margin. That's certainly right. But by that logic, we're not going to have any Pigouvian taxes on anything. By that logic, we're not going to be willing to use the price system to ration anything. We're just going to give everything away, and then we're going to answer with long lines and stockouts, right? I mean, I would have thought that we would have taken climate change is a serious thing, and we would have actually wanted to lean against people driving longer and longer distances, rather than saying, you know what we want to do for poor people? We want to make sure they can drive as long as they possibly can. I mean, it seems like what we should be doing, if we care about, you know, income redistribution, is we should be fighting for better school systems that actually upskill people who are growing up in poverty. It seems like we should be doing more to make sure that every child growing up in New York doesn't have to look over his shoulder in fear either of a criminal or of the police, right? There are lots of things that we should be doing that are, you know, about upward mobility. One of them should not be making it unforgivably cheap to drive longer and longer distances.
If you take another sector, for example, the water sector, right? The US today has 55,000 water authorities, 90+% of them.
55,000?
55,000. In contrast, the UK has about 11. They were all privatized in the 1980s, and that privatization, with it came along a very well-defined regulatory system, a regulator called Ofwat that regulates these assets and effectively determines through a negotiation process the rate of return, the regulated asset base and the rate of return that they should be effectively getting. And it's generally been hovering between 8 and 12%, which I think perfectly adequate. You look at the water sector here, there's no ability to create positive externalities and scale. At the same time, there's a fundamental confusion between the efficiency of the operations and the pricing. One is running these assets efficiently, which they're not today. And then the second is determining what is the price mechanism that you want to use, including, if you're interested from a social perspective, subsidizing groups. That's a political issue. And to the extent that they want to do that, they can target individuals and target socioeconomic groups to be able to price that accordingly. So you can price discriminate along the curve, but at the same time, it doesn't mean that you don't operate the system efficiently. And the two are mixed up together when in fact today these water sectors are massively underinvested because there's no ability either to increase the rate. The only way they can do it is through municipal debt or waiting for the government to effectively distribute money.
I'll give you a great water example of this. That currently JPAL, Joint Poverty Action Lab, is running an experiment where they actually give poorer Indians money. Right, so they give them budget, and then they deduct from that money the price of the water that they use. Right, so no one's losing. They're getting the budget, and it still has the right effects on pricing. Right, because the people see that they're paying an effective price. Right, if the redistributionary concerns are so strong, then do that. But like, let's get prices into the system.
Sadek, you invest all over the world. What's the single most important thing that you're looking for? Is it capital markets? Is it rule of law, contracts? Is it economic growth? Like, what is the thing when you're deciding between two fairly attractive projects in different places that will make you choose one?
I would say all of the above, but rule of law and clear regulatory frameworks is probably the most important one. So I'm meeting the Prime Minister of UK on Monday, and the question that they have is, what can we do to improve investment environment in the UK? Because we think it's very bad. And so my answer to them, I was talking to his team last week, I said, actually, there is nothing for you to do. Yes, of course, you can tinker here and there. But the fact is, you have an open economy, you have a very clear rule of law, you have respect for contracts, the regulatory system more or less has been the same for the last 40 years. So I can't ask for more than that. So if anything, don't change anything. Yes, improve at the margin here and there. And that is extremely important. We made an investment, without mentioning the country, where they decided to retroactively remove permitting, even though it went through the 5-year process where everyone and their grandmother vetoed it. And then at the end of the day, when this was passed, then they decided to change their mind. So that's the kind of thing that discourages people to invest very quickly.
We'll see how long he's the governor or the prime minister of the UK. They're churning through them pretty quickly. So, had you mentioned, I thought it might be fun if we did a little bit of a New York City lightning round. We do not have to look far for infrastructure dysfunctions. So kind of in no particular order, I'll throw out a topic and you kind of let me know where you think it failed and if there's any chance of fixing it. One is obviously the just massive screw up with congestion pricing that just went through this year. So I don't know what you guys think.
It's bad. What I mean, New York should have had congestion pricing 60 years ago. I mean, Bill Vickery was here when he invented the idea. He was constantly scheming about ways to reduce the operating costs. Of course we should have congestion pricing here. It does have, you're right, there are in fact poorer people who drive into Manhattan, which is itself sort of an amazing fact that you know, there are actually a significant number of lower income people who somehow or other managed to get parking working here. But it's a problem, and the city is far less functional than it should be, and in some sense, like far less equitable in many ways. I mean, there are lots of, there's a reason why the guy who pushed congestion pricing in London was Red Ken Livingstone, okay? Red Ken was socialist through and through, and he was completely convinced that by both funding his buses with congestion pricing and by enabling his buses to go more quickly with congestion pricing, he was actually taking care of the poorer residents of London. And I think fundamentally he was right. So even if there are some poorer drivers who lose, there's a way of making that cash work in such a way that in fact it is the poorest and most vulnerable New Yorkers who benefit from it. But we just have not had a leader who's had the sort of gumption of Ken to push the thing through.
And in a way, beyond the congestion charge is the fact that user fees in general, when it comes to basic infrastructure, simply do not reflect the real cost. And so it's true about the congestion charge, it's true about, frankly, ordinary tolls. You look at municipal parking on street, many of them have, the price hasn't increased in 30 years. You pay 25 cents an hour, 50 cents an hour. So I'm not quite sure who benefits. Usually it's the shopkeepers that benefit because they park their car there for the whole day and no one is able to park otherwise. So that has socioeconomic implications that people are not accounting for, but the idea of increasing parking rates is politically unsavory.
But to the conversation we were having earlier about user fees being regressive in some ways, I mean, I think ultimately, and perhaps she was looking for some air cover, the governor found some sort of mythical diner owner in Midtown who said people aren't going to come to my diner. And I don't know if you guys live in New York, nobody is driving to Midtown to go to a diner, right? The marginal person who is doing that does not exist. And I don't know, is it that our leaders are living in some Seinfeld version of New York where everyone has a car and drives around and they just don't understand? Or is it that there's more powerful interests that are putting pressure on them and that it's easier to say it's going to hurt the local economy?
I don't know. I don't want to try and get inside the mind of the governor. That doesn't seem like it's. I don't think they're ill-informed. I think they're looking at opinion polling, and I think they think this is dangerous. I think it is worthwhile. Remember with opinion polling what happened in Stockholm. Right, so in Stockholm, they pulled the thing ex ante. It was unpopular. They did it for a year, and then they took the vote, and then it passed. Right, so often I think people are much more afraid of congestion pricing, in part because they see the downside rather than feeling the upside. Right, they see the fact that they're going to have to pay rather than the upside of how things are going to change. They don't fully anticipate the behavioral response. At least that's one hypothesis of what's going on. But that requires a politician who has the courage to say, I believe in this enough that a year later, I know this is going to have support, even though up front people are scared.
Why do we not have a train that goes to the airports? The conspiracy theory is that it's the Taxi and Limousine Commission, but it's a huge percent of cars that are on the roads in New York are going to the airports. So I don't know. Is there a private sector solution for this?
I don't think there is a solution because at the end of the day, private or otherwise, because the issue of right of way and effectively changing it. The subway does go all the way to the airport, but you have to make a stop.
You have to make a stop, and it's actually quite expensive. If there's two of you going, it's almost cheaper to take a cab.
Yeah. So the fact that if you want to build that and expand it and make it efficient, will require a cost that no one will ever be able to recuperate because of the legal issues associated with it. The Bright Line in Florida is probably the only one I can think of which is a relatively new private railway that was developed. The ticket is very expensive, but it started for the first year with 5% occupancy. Today, it's about 100%. And that was because the infrastructure existed, but what they did is they were able to take that. There were no right-of-way issue. They were able to invest in it, upgrade it. But that was only possible because, number one, it was nothing to do with the government, and number two, there were no permitting as such that was required.
And it's kind of an ideal rail setting, right? Because you have a place where people are landing in large numbers, a place where people are going in large numbers, right?
That's exactly right. And then they're expanding it to Orlando, which I think is going to be another huge benefit.
Right. So there's an old joke that 40 years of transportation economics at Harvard can be boiled down to 4 words: bus good, train bad. Okay, and I think it's worthwhile remembering why John Mayer and John Kane, who are the sort of old men of that, and that doesn't mean that it's necessarily true in Shanghai or Tokyo or something like that, but it's hard to get trains to work in the US, partially because of just the enormous expense of doing them in the places that are dense, which was just alluded to, and partially because in most of America we just don't have the density levels to actually accommodate this. And I think that's probably even more so today than it was when they were writing it, because new technologies have come around. I mean, their basic point, remember, was there wasn't much that you could do with a train that you couldn't do with a bus on a dedicated lane. Okay, and their other point was, in fact, we Americans do have a lot of trains that do good things, but they move goods, not people. And trains are actually very good at moving, goods. They're just much less good at moving people. Today, there's so much going on with buses that are exciting, like make them autonomous, make them electric, run them at 150 miles an hour on a dedicated lane between 2 cities, and make sure the whole thing is owned by a private operator. And this is a wonderful model for technological change and doing something at pennies on the dollar. I still don't think it'll get you to LaGuardia, right? I still don't think it's that. But for Chicago to Milwaukee, that would be easy and cheap and just nothing like the difficulty of dealing with the rail.
But that brings us maybe to another question, which is, if you look at public transport in Europe, almost all of it is effectively privately run. So the ownership or the right to issue a bus license of course, stays with the city. But every 5 years or 10 years, depending on the life of the concession and the city, they bid it out to private operators. In fact, one of my companies, Arriva, is one of the largest bus operators in Europe. If you take the red bus in London, I'm for better or worse responsible for it. And so you have the same thing in Spain, the same thing in Germany, and so on. There, the mandate is electrify, autonomous vehicles, cheaper vehicles, more efficient vehicles, vehicles that use AI and identify the different areas to stop, the different stops, as opposed to have the more classical one where you have a well-defined number of stops. So people have, essentially it's the Uber for public transport. So you have your app and the bus would converge at some point. There will be smaller buses, more efficient, and so on and so forth. There is most of the public transport system in the US are not privately run. School buses, yes, but not public transport. So that, in a way, has also discouraged significantly innovation.
Are you using, one thing that government has a lot of that it doesn't do a great job of monetizing is data. Private companies quite good at this. Is that a way that you're actually underwriting new projects to say, we're going to have this data and there's people who will actually pay us for that, or we can use it in some way to reinvest and re-underwrite the project?
The answer is yes, but interestingly, in the case of Europe, most of that data is available. What isn't available, and pertains to you, is your operations. So how is it that you're able to minimize cost? But otherwise, passenger data, travel, everything is publicly available.
Last one on New York, because you were talking about LaGuardia. If you guys haven't been there recently, it's beautiful now. And they took advantage, obviously, of the fact that nobody was there for 18 months to move a lot of that up. Setting aside that we'll probably, hopefully, never have that particular opportunity again, are there lessons that we can take away from that new terminal and how quickly it got done and, frankly, how well it seems to be functioning?
I don't know. I'm not sure.
It's okay, but it's not particularly, it's not an exciting terminal.
I think our standards were just so low for so long.
Yes, but it's not an exciting terminal. They did use, to be fair, public-private partnership, companies that I know very well have invested in it.
And that was probably helpful.
That was helpful because they were able to put a lot of discipline around it. There was a time frame also. They had to renegotiate, in fairness, the contract because it came prior to COVID, and they had to adjust for that. But there is a bigger problem. When you look at the airports in the US, 99% probably of the airports are publicly owned. Europe, it's about 40-something, 45, 46, but call it 50-50, privately owned and publicly owned. And again, if you look at the UK, they privatize all of their airports. It doesn't mean that Heathrow is necessarily, I think it is better, but it's not necessarily good. It has its own issues, but you have a regulatory authority. And again, you have a regulated return allowed for all of the airports based on the amount of capital expenditure you put and your cost of capital. In the US, people may not realize that any profit generated from the airports has to go back and get reinvested in the airport. So the city of Florida that owns the airport generates about $700 million or so in profits. That profit goes to the airport again. It does not go to the city. And so you have that model which doesn't allow an optimization of the airports.
And why is food so expensive at airports? Why is everything so expensive at airports?
It's two-part pricing.
Yes.
It's the natural thing to do. It's also popcorn's also expensive at the movie theater in order to get the people who have more inelastic demand to pay more than the people who have less inelastic demand.
That's true. I don't want to.
Sorry, and these are concessions run by the private sector.
There we go. There we go. I don't want to get stuck in a capital markets rabbit hole, but we were talking earlier, and there is something different about the muni bond market in the way that who's eligible for essentially tax-free financing and real investment incentives here versus in Europe. And I wonder if you guys could talk about that.
This is a huge wedge. I mean, when you think about why we don't see private airports here, the fact that municipalities who run these things get access to tax-exempt financing is just a huge difference. And I think until we close that wedge, we're never going to get the thing to change. I want to make two other points on airports and then just on privatization more generally. One of which is Sabrina Howell here at NYU has by far the best paper on airport privatization. And it's a terrific paper, and it shows particularly like private equity-owned airports seem to be fantastically efficient on doing lots of different things. So I urge you to look at that. Second thing I want to highlight, in the book, you frequently repeat Deng Xiaoping's maxim about the cat being black or white as it catches mice. I share that view and have also repeated it many times. And there are, in fact, many times in which we should be appropriately skeptical about privatization. So one of my favorite stories, I'm just trying to get this in before we move off from New York, one of my favorite stories about privatization gone wrong is that New York didn't have clean water, had clean water 40 years later than it should have, precisely because of an early PPP. Right? So this early PPP occurred in the 1790s after the cholera outbreak when there was a clamor for water all up and down the eastern seaboard. Philadelphia responded to this with a public water system that worked. In New York, Aaron Burr, the redoubtable Aaron Burr, wanted a bank, and he came up with a scheme that he would get the federal city council to approve him having a bank-cum water company. So he'd be a water company that would be subsidized with the ability to run a bank. And not only that, he had Hamilton act as his lawyer. This was a few years before he would later shoot Hamilton, of course, on the shores of the Hudson. Okay, so they get this thing through, and the thing does exactly what you'd predict, which is it does a heck of a lot of banking, and it does absolutely minimal levels of water production. Okay, the entity is still with us. It was the bank known as the Bank of the Manhattan Water Company, which became the Manhattan Bank, which became the Chase Manhattan Bank, which became J.P. Morgan Chase. Right, so that is the direct lineal descendant, which then now does a lot of banking and not that much water production. This does not mean that privatization was the privatization that was necessarily a problem, but the incentive system that was done was just stupid. Right? Like saying I'm going to subsidize you to produce water by giving you this alternative, far more lucrative activity to do is a really bad design in terms of this thing. So you can get the incentives really wrong. And on top of that, in many parts of the world where, I have followed Bill Easterly's lead in being passionate about, right, where governance is really weak and bribery is really endemic, having a PPP means you have this highly incentivized private entity who has strong incentives to subvert the public entities involved and extract various rents out of them. So there are areas where we should be scared about it. Where we should not be scared about it is American airports. Okay, American airports have none of these problems, and they would be vastly better if they looked more like the norm throughout the world and were run by private concerns rather than by often underperforming public entities.
Right. And in fact, I give an example in the book where, in the case of the Chilean economy, which is generally very efficiently run, or was efficiently run, where the Department of Transportation developed a PPP framework for roads. So the people at the Department of Transportation, very smart. Some of them are friends of ours and who are with us in the same department, and came up with a structure on these PPPs. What they didn't account for was a fact is the asymmetric information between the construction companies and the Spanish companies that effectively monopolized that market and had been doing that in Spain for 10 years, 20 years before. So the Spanish companies bid on these contracts and at very low prices, so they got all the contracts, and then proceeded immediately within 6 months to renegotiate the contract. And then the Chileans were a little bit taken aback, and they did it once, twice, and then after 2 years realized that there was a con going on. And so they were able to restructure the nature of the PPPs to be able to put the proper incentives. So it's not just a question of whether these privatizations may not work because you don't have the governance. It's also because you have to have the right information. You also have to have the right monitoring. And so you would never embark on something like that unless, as a condition precedent, you have the proper regulatory framework that you can effectively then implement, monitoring with the proper penalties if someone was to do something wrong. That's right.
It's been a big couple years for industrial policy, infrastructure. I'd like to hear actually from each of you maybe a very specific thing that you think the administration got right, and perhaps a place they missed an opportunity with the infrastructure bill, the IRA, with this just sort of real rethinking of industrial policy and the role that government can and should be playing.
You go first. So I had a small hand in the drafting of the infrastructure bill.
Thank you.
And I was, I think, in Asia, and it was about 3 o'clock in the morning, and the little language that I was able to put in around PPPs was deleted. And so, in fact, there's practically no mention of public-private partnership. So I think the infrastructure bill was necessary only because there was so little investment done that needed to happen. And it took 40 years to be able to pass that, plus it was a bipartisan bill. So in that sense, I think it was absolutely worth it. What's unfortunate was, as I said, it did not include any role for the private sector, because that could have been a prelude to the kinds of things that Ed and I have been talking about. I'd say that's one problem. The second thing is, and this is, the verdict is still out, is will it encourage policymakers, mayors, and so on to invest more in infrastructure and seek other sources of funding, including the private sector. Today, if someone receives $100 million to upgrade a bridge, it doesn't cost $100 million, right? It costs more like $1 billion. And so they need to find the other $900 million. So that will force, hopefully, a reflection on how to get other sources of funding, whether it's change the user fee, or increase the tolls, or look at the privatization in one form or another. So I think that's the hope. Now, counter that is I had a conversation last week for Climate Week here in New York with 2 mayors of 2 major cities. I was on a panel with them, the 3 of us, and we talked about user fees. They said, absolutely. I said, privatization, excellent, we agree. So I was, wow, I said, that's very interesting. And at the end, when we finished and everyone left, I said, by the way, do you think the Harris administration will pass, if she wins, another infra bill? We really would like to have one. And so at the end of the day, it's very difficult to get away from direct government money, which requires you to do very little. And that creates its own disincentives. So that's my assessment of the infrastructure bill.
So I guess I share the view that it's a good thing that we're spending more, and I like that. I just wish we were also spending smarter. And I think that it can even be somewhat counterproductive to just spend more because it eliminates the need to figure out how to get better stuff out of it. But for me, the path forward is a path that involves research, involves government, involves lots of areas to sort of figure out how American productivity, both in the public sector, but also in the parts of the private sector that are, very public in nature. So think of like the construction of homes, where, the available evidence is that we've had, 50 terrible years in terms of productivity growth in these sectors.
We'll talk about housing in just a second. But I'm struck by the fact that the last two major infrastructure efforts, the one in 2021 and then the American Reinvestment and Recovery Act in 2009, have actually been stimulus efforts, right? They've been an attempt to jumpstart an ailing economy. Are we in a position where is it just politically impossible to spend money on infrastructure when we're not actually just trying to put people to work and get them to vote for us?
Short answer, yes. And I don't think you're going to get another infrastructure bill for another 10 plus years.
But that's right when we'll be due for our next crisis, right? I mean,
Yes.
we're on
And so
these.
when there is a next crisis, then you'll have an infrastructure. The key is, will the money that has been allocated and is being invested today, which we know is not sufficient, will that encourage policymakers at the city level, at the municipality, to be able to find alternative solutions than to wait another 20 years? So I tend to be optimistic on that front. When I think of two hurricanes that hit Florida, the amount of investment that will need to happen, not just to rebuild, but to upgrade that infrastructure and make it resilient to climate change, where is the money coming from? And so from that perspective, they need to be able to find solutions to effectively investments in infrastructure.
Although let me just say a word against rebuilding coastal Florida. Let me just mention that many of us think that this is probably not a great idea and probably we'd be better off effectively charging people for the effective insurance that they're provided by spending on infrastructure to rebuild them. So
I mean, that's a big thing we haven't talked about, which is that you have generations of infrastructure that were not underwritten for this kind of climate risks that have insurance policies that are never going to be renewed. Without asking you a question that has no answer, what's sort of the first practical step that we can take, perhaps coming out of these two disasters?
Well, I don't know what you mean by practical. I don't think that
Perhaps
it's
not rebuilding on the shore,
right.
but
so there are. The economics of this are straightforward, right? You want people to pay for the social costs of their actions, which includes what are the expected costs of taking care of building seawalls in Miami, which is almost assuredly is where we're going. We're not doing that, and so we're getting a lot of building in dangerous places where this shouldn't happen. How do you fix that? I don't know. I just yell about it occasionally, but I don't see myself building a consensus in the Senate in favor of that anytime soon.
But that takes us, we have a couple minutes left. And actually, we're going to do a Q&A. I have plenty of questions, but if you have them, there's two microphones up here. You guys can line up, and I'll cue you in a minute. But I want to kind of end on the politics of this, because we're headed into a very important election. Sticking with that thought for a moment, it seems that it's very hard to fix that, because we live in a country where people have a very strict view of private property and say, very strong view of land rights, and I want to build where I want to build, and I'll take that risk, except when it goes terribly, then of course I'll complain and want something. I don't know, is that something maybe when you travel around the world and you talk to different leadership in different countries that perhaps just have different notions of private property? Is that a real problem here?
Look, two things. On the issue of Florida, it's very simple. Insurance premiums have gone up by 50% in the last couple of years. You have an entity created by the state called Citizens Fund, Insurance Fund, that's effectively providing a backstop. Many people are self-insuring, so at the end of the day, in that sense, the market, the disasters that are happening are pushing the market to act a little bit more efficiently, rationally. So at the end of the day, people want to stay and live next to the beach, then so be it, right? And they won't have insurance, and they won't be effectively covered by FEMA or otherwise because the money's not there. The second question about, in a way, the governance, I think our political system is what it is. If I compare it to the UK system, it's very simple. At the end of the day, the UK Prime Minister can pass a law in Parliament, and that law passes relatively quickly, or in French, in the context of the French Parliament, even if the French Parliament were to object, there is a clause in the Constitution, clause 43-A, that effectively gives the President the right to overrule Congress or the French Parliament and to pass any law, right? Just to be clear, any law for any reason. And so they can do that. We have a much more complex system, whether we like it or not, where you have states that are sovereign, you have the federal government, and you have the complex process that we have in making these decisions. If tomorrow the UK government decided that ultimately they wanted to privatize and they think it's a good policy, there is prima facie nothing that stops them from doing that.
I don't think the problem is, I mean, I agree with what you just said strongly, but I don't think the problem is that we have too strong property rights. I think the problem is that we have a system that's geared up to subsidize insiders when they decide they complain, but also to allow insiders to object to other things that other people do on their property rights. I mean, if we want to understand what's gone wrong with American construction productivity, both in the public sector and the private sector, I think a huge part of it is the number of veto points on any project has multiplied enormously since the 1950s. Some of that's good, much of that's not good, right? And consequently, you know, in the world of housing construction, which I understand better, the largest projects in the 1950s were 3,000 unit projects, right? And the 60s, they were 2,000 unit, and they got smaller and smaller. And when you have 3,000 projects, you have guys like William Levitt who are actually engaging in meaningful technological investment to try to figure out how to get the same kind of scale economies that worked for Henry Ford to work for housing. Now, all of a sudden, if you're not getting large-scale projects through, if the projects are getting smaller, the companies are getting smaller, right? And keep in mind, when you see a large company in real estate, like particularly for single-family detached houses, they're primarily in the business of both politics and in marketing. They're not primarily in the building. They're typically subcontracting to lots of little firms. And so the firm size in construction looks nothing like the firm size, right, for residential construction, any other sector in the economy. It's dominated by firms with less than 10 employees. How are you going to get technological change from that group? If you look at, you know, the level of patenting in construction, right, until 1970, that's going along with manufacturing. That kind of looks the same. Technological innovation is something that once happened in construction, right? Between 1940 and 1970, we actually started to build a lot more houses per worker. But in 1970, as you know, my recent work shows, as the work of Goolsbee and Syverson, who pointed this out first, shows, right? Construction productivity has just gone straight backwards. And I think the natural thing is this is the result of the regulation of process, which is fundamentally different than the regulation of entry that we're used to thinking about. Regulation of entry leads to large, bloated, oligopolistic firms, but they at least have strong incentives to keep their costs down. Regulation of process means that all the projects get tiny, right? All the firms get smaller, and like nobody invests in new technologies, and you end up building homes the same way that you did in the 1960s. And this is what's gone wrong in terms of this proliferation of veto points, which has stopped the sort of, you know, technological engine, the scale economies that fundamentally enable your business to work in many cases. Like you do a lot of buses, you learn how buses are working, you get good at it, you learn enough to invest in road technology because you're handling a lot of roads, right? If it's you and your three guys doing your thing, you're not going to get any technological change. And that is the world that excessive veto points. And many of those veto points have come about once again to protect American insiders, right? To make sure that your neighborhood doesn't get changed in any way, right? That's the world that's wrought, and it's imposed huge costs on those poor Americans who don't start with housing.
There's some sense, I think, that actually YIMBYism is having a bit of a moment, though. I mean, I think there's, you know, Ezra Klein is a bit of the avatar of a certain kind of liberal who I think acknowledges that like they've made it too hard to build, and he had this column recently about the $2 million toilet in San Francisco and how just outrageous it is. He's writing a whole book about this. I don't know. Is that kind of wishful thinking?
Look. When I started working on housing regulation and housing affordability in 2000, right, 25 years ago, right, there were like 3 libertarian economists who thought this was an interesting question, right? Nobody else, right? Nobody else thought that this was something that was possibly important. Now, Barack Obama on the floor of the Democratic National Convention starts talking about how local housing regulations are a bad thing because they drive up costs. That's an incredible triumph. Now, in part, that's because, of course, we haven't solved the problem at all in the last 25 years, and in many ways it's gotten worse. But, you know, you see a dog playing chess, you don't ask how we do against Garry Kasparov, right? I mean, it's amazing that we have a YIMBY movement at all, and I'm pretty excited about that.
All right, we're just about out of time. Sadek, next book? You have another one in you?
I have to think about it.
We'll have you back. Thank you both so much. This was a really interesting discussion, and thank you all for coming. Do we have questions? Oh, I'm sorry. We did have one. I apologize. But you have to, there's a microphone over there. I didn't see anyone at the... Sorry about that. Oh, quite a few.
Hi, Sadek. Hi, Edward. Thank you so much for coming. My name is Tina. I'm currently a senior at Columbia University, and Sadek, we've met before. My question to you is, I'm really interested in how you both are talking about the importance of privatization and potentially PPP relationships. I was just wondering what you think about what are the key ways in which we could ensure that there's not the problem of misaligned incentives when it comes to balancing social impact with profitability in those scenarios. Thank you.
Chapter 9 of my book describes those solutions. I think a lot of that has to do with so to be more specific, has to do with the transparency on the mechanism by which you're effectively looking at that privatization and the way you effectively price the service that you have. And I think before you even start, so on the one hand, you don't want to ask too many people because you're going to get more opinions than the number of people you ask for. But at the same time, you have a huge amount of education that you need to do, which I think is extremely important. Every time we've spent time educating people, consumers, voters, about a particular issue at hand, and what are the benefits, and what are the implications of a privatization, you've always ended up having a better solution than otherwise. So that part of the explanation is absolutely critical. The problem is, to an earlier point that Ed was making, do you have that kind of scale to do that, right? So that becomes very difficult to scale because at the end of the day, it's very local. And I'll give you an example. We instituted a gas distribution system in India, and we added meters. There was a lot of people resisting, but we went through, government explained, and today we're offering gas to 80 million households, which they would not have had before. They have clean gas instead of using all sorts of other fuels, including dung, by the way. And so you're able to provide a massive uplift for those houses. Of course, there's a cost to it, but at the same time, we're able to bring in technology where we have had to build smart meters. And it's not that we're manufacturing 100 smart meters, 1,000 smart meters. We're actually manufacturing 5 million smart meters a year, which is going to go up to 20 million because the demand for smart meters in India is around 300 million smart meters. So think about that scale, right? And the process that we had to go through, which took a couple of years before we could get to that point.
Hello. Oh yeah. It's an honor to have you guys here today sharing about infrastructure. So my name is Min. I'm a senior at NYU, and I'm come from Vietnam, and infrastructure in Vietnam is like a very big thing. But my question is on metropolitan kind of infrastructure. So Vietnam, we grow very fast, we build a bunch of stuff, but then a natural question problem is we're running out of land, right? So now if we want to build something saying in my hometown, so there's no subway there, so people are trying to build new stuff on build a new metro system. So my question is just so when you didn't properly plan this city, should we what is the way out for it? Should we just kind of override it, build a new thing, or should we move it to another city, New Delhi? So I just want a way out for the question on the infrastructure, when you previously kind of not plan it properly.
almost never is starting from scratch the right answer,
Yeah.
right? I mean, I think whether it's and you know, I would make this criticism about Cairo that, you know, more effort should have been put to upgrading Cairo rather than thinking about visions in the desert of new cities. And certainly the same thing is true for Jakarta, that like improving Jakarta. Now, I spent some time in Hanoi over the summer, and I thought it was an amazing city. I was incredibly impressed by just the energy of the city and just the sort of sheer human teeming enterprise. Mistakes are always made, and the ideal, you know, like, that's one reason to keep things flexible, which, by the way, is yet another advantage of the bus, that you can reroute buses in a way that you can't do with trains. But, you know, I'm very bullish about Vietnam, and I think, you know, it's going to continue to grow, and I think you shouldn't think of, like, new cities. We should just think about continuing upgrading of the existing cities, and I'm hopeful.
Like, even if, you know, like the cost for it is like way too expensive, like, you know, like the land cost, like in Vietnam is crazy, you know.
You know, and the response to higher land costs are you build up, right? And so there's plenty of vertical space in Hanoi.
Hi, thank you so much for the insights. My name is Aktham. I'm a project developer of utility-scale renewable projects. As you know, the renewables industry has become overly political with local opposition in the US, and community participation, community ownership has become a big topic of interest. One thing I think about a lot is companies like China have benefited from, let's call it, extreme centralization of decision-making and prioritization of infrastructure projects. And it kind of begs the question of the potential for the decentralization of decision-making with community participation and ownership in the US. So my question to you is there an opportunity and potential for increased community ownership across different types of infrastructure asset classes to, you know, better forecast demand utilization, decrease transaction costs, and create potential secondary sources of liquidity for these projects on institutional scale projects? And what do you see that future looking like?
Well, the joke is that highways in India tend to be a straight line because they could actually do that, right? And so in one sense, they were able to build their infrastructure from the 1980s because there was a very clear plan that they wanted to develop an export-led economy. And if you're going to be manufacturing, even if you're doing it on the coastal areas, you need to have the power generation, you need to have the roads, you need to have essentially the infrastructure, the port system to be able to do that. So they spent a huge amount of time. I remember visiting the new old airport in Beijing when it opened, and I said, that's absurd. You know, it'll take them 50 years to fit it. And in fact, within 10 years, they were building another one. The same thing for Shanghai. So the scale there is enormous. So in that sense, there is an advantage in having a centralized system. But I think the disadvantages are understood, and we know what they are. In the US, you bring up an issue of liquidity, which I think is extremely important. Essentially, you're talking about developing a market for infrastructure assets. But for that to happen, you need to have a critical mass of assets so that there is price recognition and price signaling when you look at roads, power companies, which we do have, of course. So today, if I build a power plant in the PJM area, Pennsylvania, Jersey, Maryland, which is the particular power generation that you know well, within 5%, I know exactly where that particular power is on the dispatch curve. I know exactly what it costs to build it. I know exactly the equipment. And I can tell you within, like I said, 5%, whether it should trade at $800 a kilowatt hour or megawatt, or whether it should be at 1,000, depending on which node it is, and so on and so forth. That has happened over the last 30 years. And by the way, the PJM market is the largest electric market in the world, bar none. Why is it effective? Because of the fact that you have a lot of private operators that have built. Many of them have made money, many of them have lost money, and so on and so forth. So you have a liquidity in the market. The fact is, no such thing exists in many infrastructure. There are practically no roads, quote unquote, that are trading simply because you don't have a lot of privatized roads in the US. So you need to be able to have the model that allows you to be able to create that scale, and that will allow then for the liquidity to happen. In the case of the renewable sector, you have that liquidity.
Thank you.
We've got time for one more.
Thank you very much for this wonderful presentation. I'm very thrilled about your book, and I hope we will see it soon. My name is Sadek. I'm an NYU graduate student. I'm doing Masters of Arts in Economics. So today we have discussed many different types of infrastructure. Roads,
Can you lean in a little bit? I think we're having a
yes,
little trouble here.
roads, water, electricity, and many others. My question's gonna be more conceptual in general. So I have two parts of my question. The first one is, for example, we have any country. It may be the US, China, or some European countries. Is there an algorithm how we can measure the needs for different types of infrastructure? For example, roads, electricity, and others. And another question is, if we are talking about the investments in infrastructure, can we measure the optimal mix of different investments in infrastructure? And what are the factors which we should consider while creating this optimum mix of investments? Thank you.
So globally, there are a number of different ways of evaluating how infrastructure is doing. One of the nicest ones is just actually, for roads, for example, is speeds as taken from Google Maps at 3 a.m. in the morning, which gives you a sense as to how bad the roads are. And one of the facts that has recently come out of this literature, actually, Gabriel Kreindler, my colleague, was the first person who did this, and there's a great paper done by Gilles Duranton, Victor Couture, and his co-authors who look globally on this, is that, in fact, travel speeds in poorer parts of the world are not going to be fixed by congestion pricing alone. Because in fact, the 3 a.m. speeds are also 25 miles an hour because the roads are so crappy. So you actually need to have both of them. So the hard part is getting other measures other than that in other forms of infrastructure that would be that same kind of level. In principle, since, Uber drives a lot of places, I could get more stuff like the data that I have on road roughness that could complement that. There are things like various things related to the air sector that allow people to go globally as well, and Sabrina Howell's paper does that. I wouldn't say there's a natural way to sort of say what the right mix is. What we have is enormous improvements in the quality of cost-benefit analysis for figuring out how infrastructure over the past 5 years, especially the rise of the sort of fancy spatial models that anticipate how the structures will respond to the infrastructure. So key names on this are Stephen Redding, Treb Allen, and Kostas Kalakis, Nick Tsivanidis. So there are a number of people who are doing different things to enable us to better figure out what infrastructure does. And so, it's to be continued. Thank you for your question.
Thank you.
All right. We hope you'll all join us for a drink, and I think Sadek will be signing books.